Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on market and economic events. Let's get started. This week's Market Insights, we're going to change the format just a little bit. With all the market volatility, we've received a lot of questions. And Sarah, our Director of Client Experience, is off camera, and she's basically going to just throw those questions out at me, and we'll give you our thoughts on these various market events.
Okay, so first question. The S&P is close to a 20% bear market correction. How does that compare to what Caravel expected going into 2022?
So, those of you who read our 2022 Outlook, then you know the name kind of gave it away. Outlook was, remember 2000? A lot like that. And what that meant is that in the year 2000, we had a fairly overvalued equity market that suddenly confronted a Federal Reserve that was switching from pushing a lot of liquidity and newly printed money into financial markets to suddenly draining all that liquidity out of financial markets. That is the exact case, in our opinion, that 2022 presented to investors as we came into the beginning of the year. And we expected the market to drop about what it dropped in 2000, about 10%. Now, we got thrown a couple of curveballs in that forecast. So we had a war with Russia invading Ukraine and an unexpected COVID outbreak in China that caused renewed shutdowns all across the Chinese economy, but specifically located in one of their most important cities, Shanghai. All of that means that there is added inflationary pressure, and that has markets fearing two things: that the Federal Reserve will have to push rates higher than they originally expected to contain those inflationary pressures, and that we're now facing the potential for stagflation, where the economy drops into recession and inflation is high, kind of the 70s scenario. Because of all that, the market's dropped quite a bit further than we had anticipated for 2022. It's down about 20%. And we understand that motivation. We see why that happened, and we expect that by the end of the year, we may be closer to that 10% that we thought about, because we think the market may be overestimating some of the bright spots that may be present by the end of the year.
Do you think that the pain we're experiencing in the markets is mostly over?
So, forecasting the absolute end of a bear market is a very, very difficult task. But my honest opinion is I don't think we're through all of the very tough days in financial markets. The reason for that is twofold. First of all, we are just in the early days of the Fed actually tightening and actually unprinting money. There hasn't been as much actual pain in terms of liquidity being withdrawn from the market as we're going to be facing throughout the summer. Now, having said that, long-term interest rates like mortgage rates and car loans, those have fully reflected a very, very tight Fed policy. They said, we're not waiting around for the Fed to tighten, we're just going to go ahead and raise rates there. So there are parts of the economy that are already feeling the impact of higher rates, but financial markets still haven't felt the impact of the Fed unprinting a lot of that money that they pushed into financial markets during the COVID pandemic. And I think more of that pain needs to be felt before we've really felt the bottom. So that's sort of the economic monetary policy reason why I don't think we've quite hit the bottom. There's also a technical and psychological reason why I'm not sure that we've hit the bottom. And that is, I've lived through an awful lot of bear markets with 35 odd years of being a professional investor. And what typically happens before you get to the end of a bear market is two things. Number one, investors endure what they're enduring right now. Week after week of, oh my God, another down week, another loss. And then they try and rally the market back. and the rally fails, and all those people who are courageous and stepping up and buying, they lose money. And that process continues on and continues on until investors simply can't take it anymore. And they hit the panic button, and you get a cascade of selling. And it is that cascade of selling, what people call the capitulation trade, when everybody is just panicking and just eager to get rid of anything that they own, if they just to make the daily pain of watching the market go down go away. You tend to see that before a bear market has come to an end. And the other thing that you need, especially if you believe, as I do, that the Federal Reserve isn't going to be shifting policy anytime soon, then the next thing you need is a really powerful valuation and technical level that seems to make it safe for investors to start really buying aggressively. And this is going to be bad news, but I have technical support on the S&P 500 right now is another 10% down, right around 3,500 on the S&P 500. The 200-day moving average, there was several months of overhead resistance as the market was rallying up through 3,500. Those are two really powerful technical signals that investors can rally around and say, this is a safe place to buy. And unfortunately, with the exception of those two numbers at 3,500, between here and 3,500, there is no technical support. There's no place for investors to go, here's a logical place where the market should settle. So I think we might see another 10% decline. That's the bad news. The good news is I think most of the pain has already been felt in the bond market. The 10-year Treasury is close to 3%, so is the 5, so is the 3. These are all levels that I think are probably consistent with where the Fed will ultimately tighten policy. So more pain likely in the stock market, but the bond market is probably, it's probably felt the majority of the pain that it's going to feel this cycle. And the other thing is I think that 30% capitulation trade, every capitulation trade that I've lived through, it's been a good buying opportunity. And if we get that capitulation trade, maybe sometime this summer, then markets could be substantially higher than those lows. I don't think they might not be much higher than where they are now, but higher than those lows by the end of the year.
Investors are expecting the Fed to drive rates above 3%, and some are calling for 4% short-term rates. Why do you think the Fed won't have to push rates that high?
So this is a really, really great question, and I think that I've got several reasons for my belief that the Federal Reserve will not have to push rates past maybe 2.5%. Number one, and probably most importantly, is there are major sectors of the U.S. economy that are way more interest sensitive than they have typically been in the past. Let me start with the housing market. Housing market's always interest sensitive because when mortgage rates go up, that makes it harder to afford a house. But the housing market is particularly interest rate sensitive right now because for the last several years, you've been able to get the lowest mortgage rates in human history. You've been able to get a 2.5%, a 3% mortgage. Mortgages rates are now more than double that level. And that's a real problem for home builders and people still trying to sell their home. Because the flat out truth is that a home that was easily affordable at 2.5%, 3% can become utterly unaffordable for the average home buyer at a 5.5% mortgage rate. So and people understand the mortgage market, the housing market, this is a huge driver of economic activity in the United States. And it's been a big support under the recovery in the U.S. economy since the lockdowns of the early COVID days. Take that prop away and you've already seen new home sales fall 10%. We think they could fall another, new home sales, not prices, but new home sales could fall another 20% based upon the historical relationship between sales and mortgage rates. That is a lot of economic activity that just goes poof. And that's also a lot of inflationary pressures that go poof because you look at what's been happening to lumber prices in the last few weeks, and that gives you an indication of how much of the current inflation has been driven by the fact that home prices have been going up 10-15%. Cars are a very similar story. New car prices are up 12% over the last year. Used car prices are up 50%. Those prices simply aren't rational now that car loans are at interest rates 2 and 3 times what they were 12 months ago. You simply can't support those prices. So they're going to have to come back down. Those are two big sources of improvement in inflation that the Fed's going to look at and say, some things are getting better. And the places where inflation is not going to be getting much better because of the war in Ukraine, food and energy. I know what you're saying. Well, I eat and I have to drive. Why doesn't the Fed care about energy inflation and food inflation? It's not that they don't care. It's just that Fed policy can't help much with food and energy inflation. You need some sort of resolution in that war so that Ukraine and Russia can get back to exporting grain, and you also you need some rain in Argentina and Brazil and the Midwest. Those are things, Fed policy isn't going to help those things, and that's why Fed policy doesn't tend to be triggered by those things. So if you cast forward 6 months, and the housing market has slowed a lot, and auto sales have slowed a lot, and inflation outside of food and energy is starting to really roll over and come down hard. So they're seeing real weakness in certain important sectors of the economy. They're seeing improvement in inflation. And the places where inflation's staying stubbornly high, they don't have a lot of power. Add one more really important element, and that is because of the food issues, because Ukraine isn't exporting, Russia isn't exporting, and we have real drought issues in other major food-producing economies, we could be facing famine in major parts of particularly the developing world. And it will be a brave Federal Reserve that continues ratcheting up interest rates as you see major sectors of the economy declining, core inflation rolling over, and the emerging markets, which desperately need to be able to their currency to be able to buy food to feed their starving masses. A tightening Fed raises the dollar and lowers those emerging market currencies and makes it harder for them to buy food. And I think that'll be an important consideration if the Fed is seeing progress on their other inflationary goals.
Will the U.S. go into recession?
So I believe that the U.S. will go into a recession. But to quote one of my favorite bands, Pink Floyd, it will be a short, sharp shock. Where the Federal Reserve, the reason why I think there will have to be a recession is normally when you've got an inflationary problem, then higher prices cause more production. So you get more supply. So you're not quite as troubled with too few goods. And the Federal Reserve raises interest rates and unprints money, and that means there's not quite so much money in the system, and that lowers demand for products. And the higher prices lower demand for products. And the higher interest rates that you got to pay on your car loans and your home loans, that lowers demand for products. So two parts of the economy, you get more supply, you get less demand, inflation comes down. All right. This time around, the supply issues, COVID in China, Fed has got no power over that. No one has power over that except the Chinese Communist Party, and no one has any power to resolve the war in Ukraine. So there's not going to necessarily be a surge in supply to help offset the inflationary problem, which means all the inflationary work has to be done by demand, by having people buy less stuff. So why, if the Fed's going to have to drive demand down so much to get inflation down, why do I say that the recession is short and a sharp shock? Because once they've gotten inflation down in the outside of food and energy, once they've driven demand down and we've gone into that recession, normally what prolongs a recession is people have a lot of debt, people lose their jobs, companies have a lot of debt and they have to pay down that debt, and that delays the recovery. We saw this all through 2009, 10, 11, 12, 13. It was like, hey, we're supposed to be out of the recession, but growth is still really slow. Well, that's because, all these companies had too much debt. All these homeowners had too much debt, and there was still this process of paying down that debt that kept growth depressed. This time around, consumers are in great shape. Companies are in great shape. The only people who have too much debt is the US government, and they just print more money anyway. So the point is that while I think we're going to need a sharp shock recession to cure the inflationary bug, I do believe that the recovery from that sharp recession can be pretty powerful.
Do you think that China will go into a recession?
China is a very different story from the United States. The thesis I've had with China from the very first time I went there, gosh, that's been 15, 16 years ago, is, gosh, they're just imitating Japan, just like Korea imitated Japan. China is doing what I call the Asian development model. We're going to export. We're going to depress local consumption, which is going to free up goods for us to sell to the world. And we're going to be the manufacturing hub of the world, and we're going to take over everything, which, by the way, is exactly what they said about Japan, 30 years ago. Right? But then a problem happens. You get to be the second largest economy in the world. Japan got to be the second largest economy in the world in the 80s. China got there about 6 years ago. All right, when you get to be the second largest economy in the world, guess what happens? Nobody is big enough to buy enough of your exports to keep you growing. You're larger than all your customers except for the United States. And so you got to do something else to keep growing. And what did they do? What did Japan do? What did China do? Oh, we're going to have a real estate speculation. And we're going to build lots of infrastructure. And then ultimately you have a real estate bubble, and when that bubble busts, well, Japan has yet to figure out the solution for that. South Korea has yet to figure out the solution for that, and I guess we'll see if the Chinese Communist Party can manage through a real estate bust better than Japan and South Korea. Count me as skeptical, but there's no question that home sales are falling rapidly. And unlike the US, housing is very important to the US, but in China, it's like 30% of their GDP is construction. And they're trying to ramp up infrastructure spending. Again, the same old themes, exactly the stuff Japan's done for 20 years. They're lowering interest rates. Who was the first to go to zero interest rates? Japan. They're lowering interest rates. They're playing the same game. They're trying the same strategies because they've built a lot of useless real estate, and they've piled a lot of debt on that useless real estate, and now the bill is coming due. And they're scrambling very hard. They understand that they are following Japan's path, and they're trying desperately to find an alternative route. So far, I'm not seeing it. And what I think we could see is the second largest economy slips into a recession that they find very, very difficult to get out of, just as Japan and South Korea have found it very difficult to get out of. And the consequences of that, though, Japan went into a recession and stayed in a recession all through the 90s. You would think with the second largest economy in recession that the global economy would be in recession. Actually, it was one of the greatest times in global economy history. It was without question. The 90s were without question the best time for the US since like the 60s. How could that be? Well, export-oriented Asian development economies don't provide a whole lot of demand, net demand to the world. They are stingy. They try and keep as much of the revenue and the growth that is generated by their economic activity. They want that happening in Japan or South Korea or China. So when they slump into recession, it doesn't have a whole lot of impact on the global economy. That doesn't mean it won't have an impact on certain companies like Apple, like Mercedes, like BMW, that sell a lot of their goods in China. If China slumps into a recession, those companies will absolutely feel it. But that, it doesn't necessarily have the same implications for the global economy.
With all these various risks, what should investors do?
So, what should investors do? The very, very first piece of advice that everybody should get is don't panic. All right? The worst thing you can do is just watch the market go down, 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 and then do something that you're going to regret a year from now or 18 months from now. So, calm down. I don't think anyone loved themselves after liquidating their portfolio at the lows of 2008. No one did. And I do believe that the longer term story is not much diminished. I don't believe we're going to have a 70s stagflation. I don't believe this is a long-term systemic problem. We printed money for 2.5 years. In the 70s, they printed it for 10 years straight. It's a big difference. All right. So, number one, don't panic. Number two, I think it's safe to start buying bonds, which I've hated bonds. We've said very, very consistently for, since 2018, we've said bonds are not a great investment. They're below inflation. They're a money loser long term. That's no longer, they're below inflation short term, but I think the Fed will ultimately get inflation back down below 2.5, 2, and I think you're going to see a 3% treasury. It's going to look fairly attractive. More importantly, bonds are now doing what they're supposed to do. When bonds are close to zero, bonds can fall and stocks can fall. Once bonds get up to about 3%, then they can do the great thing that they normally do in your portfolio. Stocks fall, but bonds rise and help cushion the pain. They can't do that when rates are close to all-time lows, but now that they're back up around 3, they can add that counterweight to your portfolio. Third thing is get ready psychologically. One of the hardest things to do, people always like to say, I like to buy low. But when the time comes to buy low, there's only one reason why stock prices are low. Because people are freaking out. Everyone is scared. Everyone that you're talking to is telling you how they couldn't take it anymore and they're having to sell. You're going on CNBC and they're talking about the end of the world. And if you can right now write down, if the S&P gets to 3,500, I am going to buy X%. I'm going to move from cash and bonds this much of my portfolio. And just do it. All right? And then there's one last really important thing. And if this sounds self-serving, it's only because it is. But investors need a financial plan, a goals-based financial plan that tells them specifically, customized for their specific life goals, their specific risk tolerance. They need to know exactly how their 529 should be allocated to make sure they can fund college. They need to know exactly how their IRA and 401k need to be invested so that they can be fairly assured of funding a comfortable and dignified retirement. You need that kind of guidance because it can help you avoid panic. And if you build in conservative enough assumptions, you will know that even though this feels really, really bad, it's not as bad as 1907 financial crisis, which then led to World War I, which then led to the Great Depression that had World War II and another bout of inflation. If you build your plan to survive that, then it's not as bad as that, so you are still in good shape. And those are the kind of analytics and those are the kinds of guidance that Caravel Software is designed to provide. Thanks for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like the video and share it with your friends. If you'd like to see more of our research or learn more about our game-changing investment, asset allocation, and planning software, check us out on caravelconcepts.com.